Right now, a story is spreading across dinner tables, church parking lots, and family text threads all over the country. It claims that if you have passed your 65th birthday, the federal government just dropped a fresh $6,000 tax deduction into your lap. Some versions of that story even go further, insisting that your Social Security income is now completely off the hook from taxation. Here is the truth. One part of that story holds up. The other part is going to quietly drain people's bank accounts if they believe it without checking. Because the deduction is absolutely real. It is embedded in federal law. It has a specific form attached to it, and it is sitting there right now ready to be claimed. But whether you walk away with the full amount, a portion of it, or nothing whatsoever comes down to a single figure on your tax return, and almost no one is looking at that figure before the window to act closes. By the time this video ends, you will understand exactly what this new $6,000 deduction is and where it originated. You will know the specific income figure that determines whether you collect the full benefit, lose a chunk of it, or end up with zero. You will recognize the 4 categories of retirees this deduction does absolutely nothing for, so you are not sitting around expecting a check that will never arrive. And you will know the specific form and the exact line where this deduction is supposed to appear, so you can verify with your own eyes that you actually received it. Before I move any further, let me address the thought that causes most people to stop watching a video like this one. You might be telling yourself you already submitted your return, or that your tax preparer manages all of this so it is not your concern. Or maybe you are leaning the other direction, thinking this is just another flashy internet tax scheme that collapses the moment anyone examines it closely. Both of those reactions miss the mark, and here is the reason. This is not a scheme. It was born from tax legislation passed in the summer of 2025, and the IRS has laid out the rules for it in plain, published language anyone can read. And even when someone else prepares your return, you are still the person who puts your name on it, and you are still the one who lives with whatever comes next. Understanding this for yourself is how you spot the error before it becomes permanently your error. So whether you prepare your own taxes every spring or hand a folder to someone else and walk away, stay with me. Now, a genuine disclaimer, and I mean every syllable of it. I am not an attorney. I am not a certified public accountant, and I am not a personal financial advisor. Everything covered in this video is educational content based on current 2026 rules and publicly available information directly from the IRS. Your circumstances are entirely your own. Your income, your filing status, and your age produce numbers that belong only to you. So verify everything here with a qualified professional before you take any action. My name is Harrison, and on this channel, I take retirement rules that the system buries in fine print and translate them into plain, usable language before they end up costing you. If that kind of content is valuable to you, take one moment and press the like button and subscribe right now, because this $6,000 deduction is only written into law for a limited number of years. The retirees who grasp it early are the ones who will actually pocket every dollar of it before the opportunity disappears entirely. So let me ground this in something concrete, the way I always do. Let me walk you through the story of a woman named Diane, because her experience is going to show you exactly how this whole thing operates, where the money actually lands, where it begins to slip away, and at what point it disappears completely. For a long time, the federal tax code has quietly given people who have reached age 65 a modest extra benefit. On top of the standard deduction that every taxpayer in the country can claim, seniors have received a small additional standard deduction, a quiet bonus simply for reaching that milestone. It has existed for years, and most people never noticed it because it simply folded into the arithmetic on their return without any fanfare. Then, in the summer of 2025, a sweeping piece of tax legislation changed the landscape. That law, which you may have come across under the name the One Big Beautiful Bill Act, introduced something entirely new layered on top of everything that already existed. For the very first time, if you are 65 or older, you can claim an additional deduction worth $6,000. $6,000 per individual if you are married and both you and your spouse have crossed that age threshold. That is $6,000 for each of you, which means $12,000 removed from your combined taxable income. And here is the detail that consistently trips people up, so I want you to absorb it fully. This is not the same as the older additional deduction, and it is not a substitute for it. It stacks directly on top of it. You receive the regular standard deduction. You receive the long-standing bonus deduction for being over 65. And now, layered on top of both of those, you may also receive this new $6,000. Three distinct things stacked one upon another. It even arrives on a brand new dedicated tax form. That is how legitimate it is. But, and this is the sentence I most need you to retain, it does not exist indefinitely. This deduction was written into law to apply to tax years 2025 through 2028. After that, under the law, as it currently stands, it simply vanishes. 4 years, that is the entire window, which means the retirees who understand it right now are the ones positioned to take full advantage of it while it is still available. So let me show you what that actually looks like in real money, using Diane as our example. Diane is 68 years old. She devoted nearly 3 decades to working as a county clerk in Ohio before she retired. The kind of quiet, steady, essential work that keeps an entire county functioning. Her husband passed away a few years ago, so she now files her taxes as a single individual. Between her Social Security payments, a modest pension, and modest withdrawals from her retirement account, her total income lands at around $58,000 per year. Now watch how the numbers stack up for Diane on her federal return. She claims the regular standard deduction for a single filer, which for the 2025 tax year is $15,750. Because she is past age 65, she also qualifies for the older additional standard deduction, which contributes another $2,000. And now, thanks to this new law, she adds the $6,000 senior deduction right on top of those. Add all three together. $15,750 plus $2,000 plus $6,000. That equals $23,750 that Diane is allowed to subtract from her income before the government even begins calculating what she owes. Read that figure again because it consistently astonishes people. Nearly $24,000 lifted off the top of her income before a single dollar of tax is computed. And a substantial portion of that, specifically the $6,000, simply did not exist for her 2 years ago. Let me translate that into what it actually means in dollars she keeps, because a deduction only carries weight when you measure it in real money. Diane falls into a relatively low tax bracket of around 12%. A $6,000 deduction at 12% equals roughly $720 that stays in Diane's pocket rather than traveling to the IRS. Not a life-changing fortune, but $720 in real, tangible dollars every year. This deduction remains available simply for being exactly who she already is. And here is what I want you to notice about Diane's situation. She did not do anything sophisticated or clever. She did not retain an expensive strategist. She did not uncover a loophole. She simply met the qualifications. She is over 65. She holds a valid Social Security number, and her income falls below a specific threshold. That is the entire formula. And because her income sits comfortably beneath that threshold, Diane receives the complete $6,000, every single penny. But before you settle into comfort, I need to stop and address the second half of that rumor I raised at the very beginning, because this is the part where people get genuinely misled. You may have heard someone claim that this new law made Social Security benefits completely tax-free for seniors. I understand exactly why that idea took hold. It spread across every platform imaginable, but it is not what actually happened. And if you build your financial plans around something that is not accurate, You will face painful consequences. Here is the accurate version. This law did not eliminate taxation on Social Security benefits. The existing rules that govern how much of your Social Security gets included in your taxable income, the ones calculated using your provisional income, remain exactly where they have always been. What this new deduction accomplishes is something different. It gives you a larger amount to subtract from your income, which can reduce your overall tax liability. And for certain people, that reduction brings the effective tax they pay on their benefits down very close to zero. But the deduction and the Social Security taxation rules are two completely separate mechanisms. One did not replace or cancel the other. Why does this distinction carry so much weight? Because if you believe your Social Security is now completely untouchable, you might pull a large sum from your retirement account assuming it creates no tax consequences, and then face a deeply unwelcome surprise when tax season arrives. The deduction helps. It is real and it genuinely carries value, but it is a deduction, not an impenetrable shield. Keep those two concepts clearly separated in your mind, and you will not get caught off guard. Now let me get to the number I promised you, the single figure that determines whether you are Diane walking away with the full $6,000 or someone watching their benefit quietly shrink toward nothing. That number is your modified adjusted gross income. It is a mouthful, so let me put it in plain language. It is essentially your total annual income with a handful of specific add-backs that the majority of retirees do not even have. For most people watching this video, it is extremely close to the income figure you can find near the bottom of your tax return. Here is where the boundary sits. If you file as a single individual, the complete $6,000 deduction remains fully intact as long as your modified adjusted gross income is at or below $75,000. If you are married and filing a joint return, that boundary sits at $150,000. Below the boundary, you are living in Diane's world. You receive the full amount. But the instant your income crosses that line, the deduction begins to erode. For every dollar of income above the threshold, 6 cents of your deduction disappears. 6 cents per dollar. That may not sound like a serious number until you run it against real figures, and it continues eroding until, at a sufficiently high income level, the entire deduction reaches zero. For someone filing as single, it is completely eliminated once income reaches $175,000. For a married couple filing jointly, it is completely gone at $250,000. So this is not a simple yes or no benefit. It is a gradual slope. Where you land on that slope is determined entirely by that one income number. And as you are about to discover, that gives you considerably more control than you might assume. Let me make that slope concrete with a second person. Meet Raymond. Raymond is 71, a retired regional sales manager who now lives in Arizona. He had a strong career and files as a single individual. When you combine everything, his pension, his Social Security payments, and the withdrawals he takes from a well-funded retirement account, his modified adjusted gross income comes to approximately $100,000. Raymond is over 65. He holds a valid Social Security number. On paper, he qualifies for this deduction in exactly the same way Diane does, but Raymond has crossed above that $75,000 threshold. So let us trace the math the same way the IRS would trace it. Raymond's income is $100,000. The threshold for a single filer is $75,000. That puts him $25,000 above the line. Now apply 6 cents on every dollar above the line. 6% of $25,000 equals $1,500. That is how much of his deduction is erased. So Raymond does not collect the full $6,000. He receives $6,000 minus $1,500, which equals $4,500. Still a genuine benefit, still worth having. But look at what just happened. Raymond quietly lost $1,500 of a benefit simply because of where his income happened to land. And there is a reasonable chance no one ever sat down and explained to him that the threshold even existed. Now, here is where things get genuinely interesting, and this is the piece I most want you to absorb. That income figure is not always permanent and immovable. For certain retirees, the timing of a single withdrawal or the decision to draw slightly less from a pre-tax account in a given year can be the difference between landing below that threshold with the full deduction intact and landing above it, watching the benefit dissolve. I am not prescribing any particular course of action. Your situation is exclusively yours. I am telling you that the threshold is real. The mathematics are knowable in advance, and the person who knows their own number before December has choices available that the person who discovers it in April simply does not. Let me pause and ask you a genuine question because your answer tells me something real about who is watching. Before this video, did you already know that this $6,000 deduction phases out at higher incomes and that you could lose a portion of it without anyone ever informing you? Type yes or no in the comments. I read everyone and they shape what I focus on next. Now, let me walk through the married couple version, because for those filing jointly, there is a twist that catches even thorough planners completely off guard. Picture Patricia and James, both 70 years old, married for 41 years, and filing their taxes together. Between two Social Security payments, a pension, and retirement account withdrawals, their modified adjusted gross income for the year comes to $178,000. Because both of them have passed age 65, they begin with the full combined amount, $6,000 for Patricia, $6,000 for James, and $12,000 altogether, but their income exceeds the joint filing threshold of $150,000 by exactly how much? $178,000 minus $150,000 equals $28,000 above the line. Here is the twist that catches people. The phase-out calculation applies to each of them individually. 6% of $28,000 equals $1,680, and that reduction lands on Patricia's portion separately and on James's portion separately. So the $12,000 they began with gets reduced by $1,680 for her and by another $1,680 for him. That is $3,360 erased from their total. $12,000 minus $3,360 leaves them with $8,640. Still a meaningful deduction, but observe what their income level produced. A couple sitting only $28,000 over the line lost more than $3,000 worth of benefit because the phase-out calculation doubled once for each spouse. This is precisely the kind of detail that never survives long enough to make a headline, and it is exactly the kind of thing that determines real dollars at your actual kitchen table. And this is precisely the reason I put together something to accompany these videos, because a video can walk you through how the phase-out functions, but it cannot sit beside you while you work through your own specific numbers. So I wrote a short guide called the Retirement Money Defense Playbook, which takes you calmly through how to use everyday AI tools to research your own retirement questions, including a straightforward method for checking whether the answer you received is actually correct before you ever act on it. It is the resource I wish someone had put into my own parents' hands. The link is in the description if you would like it. Now back to the core content, because we are approaching the most consequential part of this video. And if this is opening your eyes even slightly, take just a moment and press the like button. It genuinely helps this video reach other retirees who have no idea this threshold even exists, and reaching those people is the entire purpose. I promised you honesty throughout this video, and honest means telling you plainly who this deduction does absolutely nothing for. Because there are 4 distinct groups of people, this $6,000 benefit will not help at all. And if you belong to one of them, I would far rather you know that now than spend months waiting on money that will never materialize. The first group is the one that carries the sharpest sting, and it is not a small group by any measure. It is lower-income seniors who already owe little or no federal income tax whatsoever. Think carefully about what a deduction actually does in mechanical terms. It reduces the income on which you get taxed, but if your income is already low enough that you owe essentially nothing to begin with, then reducing it further does not place a single dollar back into your hands. Picture a retiree whose primary income source is a modest Social Security payment. That person may already be paying zero in federal income tax. For them, this new $6,000 changes absolutely nothing. And that is a genuinely difficult truth because those are frequently the very people who need financial relief the most. The second group is people who are legally married but file their returns separately from their spouse. The law is unambiguous on this point. If you file separately from your spouse, you are simply ineligible to claim this deduction. Not a reduced version of it, none of it whatsoever. So if you and your spouse file apart from each other for any reason, this represents a real financial cost worth being aware of and a conversation worth having with a professional before you finalize how you choose to file. The third group is high-income retirees. We already walked that slope together. Once a single filer's income reaches $175,000 or a married couple's reaches $250,000, the deduction has been completely eliminated. Zero remains. If your income sits above those figures, this particular benefit simply does not exist in your financial picture, and no amount of paperwork alters that reality. And the fourth group is people who have not yet reached age 65. I recognize that sounds self-evident, but I include it intentionally because I regularly hear from people who retired at 62 or 63 and assumed that any new tax benefit labeled as a senior benefit must naturally apply to them. It does not. The rule is anchored to a firm age requirement. You must reach age 65 on or before the final day of the tax year to qualify. Retire early if that decision makes sense for your life, but do not construct your financial plan around this particular deduction until you have actually crossed that age threshold. So there it is, the complete and honest picture. For a middle-income retiree over 65 like Diane, this is a genuinely valuable benefit worth pursuing. For those four groups, the result ranges from partial to nothing at all, and knowing clearly which category you fall into is worth infinitely more than any headline you encounter online. So let us convert all of this into something you can actually put to use, because a video that only generates anxiety without providing direction is not what this channel is designed to deliver. First, confirm the 3 facts that decide virtually everything: your age at the close of the tax year, your filing status, and your modified adjusted gross income. Those 3 pieces of information tell you almost the entire story. If you are 65 or older, not filing separately from a spouse, and your income falls below the threshold for your particular filing status, you are very likely eligible for the full amount. Second, know where this deduction is supposed to appear so you can verify you actually received it. This is not something buried in an obscure corner that you can never locate. It has its own designated place on a form called Schedule 1A within the section specifically for the enhanced deduction for seniors, and your specific amount appears on line 37 of that form. If you prepare your own return, look for it deliberately. If someone else prepares your taxes, you are completely within your rights to ask them one simple, direct question. Did you apply the new senior deduction, and did my income level have any impact on it? A competent preparer will respect that question without hesitation. An excellent one will already have the answer prepared. Third, and this is the move most people completely overlook, if your income is hovering close to that threshold boundary, this transforms from something that merely happens to you into something you can actively plan around. The size of a retirement account withdrawal, the timing of a Roth conversion, the sequence in which you draw from different account types. These decisions can shift your income above or below the line that determines whether you retain the full deduction. I am not advising you to pursue any one of those specific strategies. I am telling you that they are worth understanding clearly and worth discussing with a qualified professional while there is still sufficient time remaining in the year to act on them meaningfully. And fourth, keep the deadline in clear focus. This deduction is written to remain in effect through the 2028 tax year, after which, under current law, it simply disappears. So this is not a someday opportunity. It is a right now, next few years opportunity. The retirees who treat it with that sense of urgency are the ones who will have actually extracted every dollar of value from it before it is gone. Now, I want to be transparent about what a video like this one genuinely cannot do. I have given you the general rules, and they accurately describe the situation for the vast majority of retirees who are watching. But your circumstances are uniquely yours. Your income sources, your filing status, your state of residence, and the precise composition of your accounts are specific to your life alone. So please do not close this video with only a vague impression that some benefit is floating out there somewhere waiting for you. Close it and actually run your real specific numbers against that threshold, or bring them to someone qualified who can, so you know with certainty exactly where you stand. Before I let you go, 2 brief questions, because your responses genuinely influence what I focus on next. First, before watching this video, did you know this $6,000 deduction existed and that it gradually phases out as your income rises? Type yes or no in the comments section. Second, tell me where you currently find yourself in life. Are you already fully retired? Are you a few years out and actively building your plan? Or are you an adult child helping a parent work through all of this from the outside? That tells me exactly who is on the other side of the screen and what you most need me to break down next. Here's the thought I want to leave with you. The people who miss out on opportunities like this are almost never people who lacked options. They are people who simply never learned the option existed until the moment to use it had already slipped by. A deduction written into law helps absolutely no one while it sits in a document that nobody reads. It only becomes real money when a person like you understands it clearly, measures it against your own actual circumstances, and claims what legally belongs to you. That, more than anything else, is what this channel exists to accomplish. To ensure that the rule buried in fine print does not quietly pass you by without you ever knowing it was there. So, if this video delivered something useful to you today, hit subscribe so that the next time the system quietly shifts something important, you are not left discovering it after the fact. And send this video to one person you care about who is over 65. That single share could genuinely be worth thousands of dollars to them at tax time, and they may not have heard a single word of any of this otherwise. That, more than anything, is what this channel is here to accomplish. I will see you in the next one.